just remember, the idea of it is not to just buy anything either. There is A grade, B grade, C grade, and D grade properties all over the real estate marketplace. And again, as I alluded to, I'd rather buy a grade secondhand property than a D grade off the plan new property, right? However, I'd prefer to buy an A grade brand new property than a C or D grade secondhand property. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show is a code cracker. We're going to dig into the current market landscape, what it takes to buy real estate today in the Australian economy, and of course, talk about some of the ways to see through some of the lemons in the marketplace. Yes, if you want to avoid lemons when it comes to real estate, today's show is particularly pertinent to your world. If it's your first time tuning in to the Urban Property Investor, welcome aboard. We like to play the show in double speed on this program. The reason being, I don't sound like a chipmunk, and of course, you get to get some of your life back. So speed me up. If you don't know how to do that, just simply use Google. When it comes to the show, we never know if it's going to be a good show or not until we get to the end. So you're just going to have to wait to see if this show actually makes sense when it comes to property investment. Hey, if you like the idea of education, make sure you check out some other episodes as well on the Urban Property Investor. They're all actually episodes and education pieces, which is pretty cool. Hey, I tell you what's not cool. My new glasses. Yes, I have glasses. I had no idea I couldn't see. I've been taking a form of Ventolin for asthma for 2 years. That's been empty. The bottle's been empty. I haven't been able to actually see that it says it's empty. Oh my God, I had no idea. I thought I was a Qantas pilot. I thought I had eyes like a Qantas pilot. I don't. It's interesting getting older. What I was famous for? I was famous for being 2020. Yes, I was the guy. I was the guy you could take on a fishing boat that could spot a whale, spot a dolphin, spot a school of fish. Now, I don't know. I'm in shock. I literally got my first pair of prescription glasses, which I'm now wearing. So if you're watching on YouTube, you can see my new look. I tell you what, it feels pretty good. I have to admit, having glasses is a thing for me. When you're bald, you're always looking for little plug-ins around your face to try and sort of soften the fact that you're basically a little bald male species. So you're wearing the hats, sunglasses are a big thing for a bald man. Now reading glasses, it's a new thing, but I'm digging it. I'm down with it. And the good news is I can see my asthmatic medication. So for the first time in 2 years, really first time since the pandemic, I can have a puff of the good stuff. So there you go. There you go, guys. If you can't see, if you feel like you can't see, make sure you go and get your eyes checked. That's my tip today. That should be the end of the podcast, shouldn't it? That's a gold nugget right there. Make sure you can see. That's more important than real estate. But I tell you what, when it comes to health and well-being, I think we do need to actually make money out of real estate. I don't know about you guys, but I think I spend maybe $1,000 a week on trying to be healthy. I've got superfoods being delivered. I've got, the gym membership, the Pilates membership. I've got, I've got the massage membership. I've got like the chiropractor. I don't know. It's pretty expensive trying to be healthy, right? And, I think there is some science around the idea that people, who are able to make a little bit more in this world can certainly look after themselves a lot better. And, if anything, getting glasses has taught me that I'm just so grateful that, I can sort of take care of my health when I need to. And of course, a lot of that comes out of the workmanship I put into understanding the real estate marketplace. So today's show, we're going to dig into, what makes a great property, what makes an A-grade property, a B, C, D-grade property. We're going to look into the lens of what is going on in the real estate market for 2022. We're not going to take a full in-depth look at data. We're actually going to spitball, if you like. Who likes a good spitball? I do. Let's spitball the idea of potentially buying some real estate in 2022. What do you need to look out for? What are the pros and cons of the real estate market in 2022? And how do we cut through the noise to make sure we don't buy a lemon? We don't want a lemon. This show is about avoiding lemons because 2022 is the year of the lemon property. Yes, folks, as I've spoken about in past episodes, probably dating back to 2020, I have a lemon in my portfolio and I have been waiting patiently for the year to offload that lemon. And guess what this year is? The 2022 is the year of the lemon when it comes to property investment. So I need to teach you guys how to avoid the lemons and understand what a triple A property is, a double A, an A, a triple B, a double B, B, a C, or triple C, double C, and a C grade property. And I could take it further into the Ds, but I think you get the point. I'm going to teach you all about that. And you're going to go, wow, that makes a lot of sense. And you're going to feel good about listening to this podcast. So, hey, let's crack on. You don't need to hear about my new fetish with my reading glasses. But let's face it, we're in a real low rate economic environment. It will be like that for a long time, even if interest rates buffer about a bit. It's still historically very, very low when it comes to interest rates. I think interest rates will be quarantined at a fairly low rate for quite a while. We're obviously got, what people would in inverted commas determine as transitory inflation. Generally, when migration comes back into Australia, a lot of the shortages will stop. And of course, that should also slow back some of the transitory inflation. But at the end of the day, real estate is a bit of a sport in Australia. People love real estate. If you go to a barbecue, you generally end up talking about real estate, or I do. People tend to like to talk to me about real estate. But I think for most Australians, their wealth is in their family home. The wealth is in property investment. And as such, we have seen the best of the economic backbone of real estate investment off the back of the pandemic. Banks, government, everyone wants to protect this thing called real estate because the wealth effect spending, if you like, is generally based on the back of people feeling quite wealthy from their assets. And the greatest asset here in Australia is property, right? And so it's not like that necessarily in other countries around the world. Property investment is more just basically shelter. Here, though, property investment is completely different. There's a whole migration system built off the back of building more houses, building more coffee shops, creating more communities, right? And so I've been through that in my migration episode. So go check that out if you're not familiar with how the Great Australian migration system works and why it does link to the concept of property investment. So how will the real estate market slow, and will it slow in 2022? For me, I don't think so. Many economists have sort of predicted some pretty good growth, anywhere from sort of 5 to 15%, right? And a lot of that is because people are very keen to change where they live. And of course, people are ultimately one of the biggest drivers of real estate shopping, if you like. And if the overall sentiment is, I just need to go out and get this done, people will go and do it. Remember, the opportunity for most people today is to take advantage of low rates and upgrade their living standard, whether that's borrowing some equity to renovate, or whether that's changing suburb, or whether that's changing property. That is what is going on. The great spatial transformation is unfolding. So, and I can see why. Like, you only get one life. And for a lot of Australians, it's like, well, I'd prefer to live somewhere better by capitalizing off the low rates and buying a better home. And that is fundamentally what is unfolding. People are upgrading their lifestyle. And it makes a lot of sense to me. At the end of the day, you want to live the best possible version of your life. And of course, if that means buying a better home or moving to a better suburb or upgrading to a better property, you go do it. You get it done. And when interest rates rise one day, you deal with it, right? That's what being a grown-up's all about. And so the people sort of hiding under the rock, worried about how the world will unfold, will probably always be hiding under a rock, worrying about how the world will unfold. As they say, as the saying goes, the same wind blows on us all. So the wind of change, the wind of disaster, the wind of opportunity. And of course, to capitalize on a lot of that, you need to be a player in the game. Really, when it comes to three versions of slowing down the real estate market, you could be slowed down by sentiment, the people, you could be slowed down by the cost of money, or you could be slowed down by the government. And I don't think it's going to be the cost of money that slows down the real estate market, nor the people who are ultimately looking to upgrade their life, including the millennials, which are out and about in droves. I think it will be the command-led economy, the government basically going, you know what? The wealth effect is unfolded. We are now got other levers to pull, including more migrants into the economy to stabilize the economics of Australia. You know what? Do we really need houses to keep going up in value, or property going up in value? They've done it before. They've put the squeeze on before. It is the new world, right? You play this lever game with the government. So what have they done in the past? Well, as you know, there was a boom between 2013 and 17 in Sydney and Melbourne, right? Prior to the current boom. There was a previous boom which made a lot of money for people who had invested in Sydney and Melbourne. What happened then? APRA stepped in and squeezed the lending conditions for investors, took investors out of the market. They did that 3 times. They put in a regulation to squeeze money flowing. So real estate is not only driven by the cost of money, but it's driven by the flow of money. And so if money starts to cost more or flow less, then of course that becomes a problem to most people, and certainly you remove more buyers out of the market, thus creating less demand. The counter argument is we're in a massive undersupply anyway, so removing some buyers from the market isn't necessarily going to make the market go down in value, and that's where we probably find ourselves today, where auction clearance rates are still very, very high around the country, very healthy levels. Clickbait news will probably say they're dipping. They certainly are dipping from record highs, but they over the long term are still very, very high auction clearance rates around the country. And so I think you're certainly seeing some of the activity unfold in the economy where there's still a lot of interest for real estate. Now, as real estate markets go up in value, you obviously lose choice. That's as simple as it is. When the market is at a bottom level, when you're at the bottom, you can fundamentally buy the A-grade suburbs. When the market is rising in value, you sometimes get pushed out to the B-grade suburbs. When the market is quite hot, you're getting pushed to the B-grade suburbs. You want to be in the A and B-grade suburbs. And of course, quite often when the market is in decline, people are shopping in the C-grade and D-grade suburbs, and those people tend to get quite burnt from the real estate marketplace. So we need to understand, if we are going to shop in 2022, what is going on, where we can shop, and how to determine what is a great A-grade property and what is, fundamentally a D-grade property, and how it works when it comes to making sure what you buy within your budget is as close to being a or even a B property, but avoiding those C and D really economic death traps. So as I've alluded to in past episodes, when it comes to real estate, there are some places you can buy. You can go to regional Australia, rural Australia. You can go to brand new communities that are popping up on the edge of cities across Australia. You can go to the efficient real estate inner and middle ring. All of it is possible for property investors. However, obviously, the better the efficiency of infrastructure, generally the better the price. So if you go to, try and buy a house 5 kilometers from the CBD of Sydney, you're going to need a lot of money. So for property investors, right now, a lot of property investors are losing proximity off the back of the stimulus boom, the great pandemic boom that COVID has delivered. So a lot of property investment into the future will be based around buying a little bit further out, buying in new job centres. And really, if we were to look at where the affordability is when it comes to this thing called real estate, we've got to sort of do some mapping to understand what is going on when it comes to price extremes. But as we know, if we can spend more, we're probably going to make more in real estate. And some of the A-grade suburbs, if you like, they're really good to get into because they go through this concept, which I've explained once before, I believe, known as investor lock. So when you think about the mass production of real estate, it's generally designed for investors and first home buyers. And of course, if you can buy in a suburb where that mass production has ended, in other words, it's too expensive for investors and it's too expensive for first home buyers, which typically buy sort of sub 700, you're going to have less supply into the future because for stock producers, they have no way to mass produce real estate. They have no market, if you like, right? So there is an element of truth when it comes to the idea that if you can spend more, you kind of get the clean air when it comes to real estate. Less, turbulence, if you like, when it comes to real estate. Now, remember, when we think about suburbs which are available in the marketplace, if they are more expensive, they tend to make money a little bit more efficiently because they need less capital growth to deliver a dollar result. So what do I mean by that? If you've got a $2 million suburb and it grows by 10%, there's 200,000, right? If you've got a $400,000 suburb and it grows by 10%, you're at 40,000. Okay. So, obviously the rich are just getting richer because for a $5 million house to become a $6 million house, to make $1 million, they don't need 100% growth. They just need, 10 or 15% capital growth every now and then. And there's another $1 million for that person. So the clear air is spending more, but a lot of property investors can't do that. And when I started property investing, I couldn't do that. It's taken me near on 20 years to get to clear air, where now when, 10% growth comes along, my portfolio can make $1 million. It's as simple as that, right? So I don't need as much growth as everyone else to become wealthy. And the reason being is I put the big rocks in first, and I'm now in the little rock section, right? I don't even need more real estate. That's the reality of it. I'm buying more real estate, but I don't need more real estate. And so quite often a good way to look at the real estate market is to try and find the clean air. But for a lot of people, they can't. And so I need to explain to you how to play in the dirt. And I tell you, I've got the lashes on the back for understanding how to play in the dirt. And there's nothing wrong with being in the dirt. I've been in the dirt my whole life, and it's only now I'm getting out of the dirt. So I'll teach you how to understand what is fundamentally going to unfold, and also what to look out for when it comes to playing in the dirt. All right. So as we know, Australia is still very much under supply, and supply isn't coming to fix the affordability issues in Australia really anytime soon. If anything, we are becoming really, really challenged when it comes to being able to deliver new stock to the marketplace. There's a lot of shortages, as we know right now at the time of delivering you this podcast. Shortages in supplies, in people, in trades. And of course, all that ultimately means is stock production is slowing right down. What was taking 6 months to deliver is now taking a year and a half to deliver. So that time frame, if you like, is now blowing out. And of course, new stock coming to the market is not going to come along and necessarily cool the market down either, right? So when we think about the great coolers of real estate, sentiment, that's not going to cool. Supply, killing demand, that's not going to cool. Interest rates rising, not necessarily going to happen. And really the only coolant I can see again is government intervention, which will no doubt annoy everyone into the future. So the first rule about looking or shopping in the real estate market in 2022 is, if you don't understand, don't do it, right? Don't just take a leap of faith in 2022 into the real estate marketplace. That could be a silly thing to do. Let's give you some education so that you know what you're going to do, what you're embarking on. Because again, 2022, we've seen a great transformation of wealth unfold. We've seen property prices tick up in value. We have seen assets double in value in some places. And so the idea of going and buying an asset which has doubled in value in the last 12 months and paying for that is potentially flawed, right? So we need to necessarily take a look at the real estate market, take a step back, take a breath, and work out how we can best buy in 2022. And there is still some really, really, really good opportunities out in the marketplace. It certainly has, in my opinion, evolved into a marketplace where there is some very good niche level of growth available for property investors, and it's just a matter of understanding where to go, what to look for. Now, I might come back and do a podcast on some growth models for everyone for 2022 in perhaps the next episode. But for now, I just want to really set some foundations that you should potentially consider when it comes to, asset allocation and finding the right property for you. This is ultimately what it's going to take. The reality is you're going to have to be a little bit patient. If you don't find the right deal in the next week or two, it doesn't mean you should just buy anything that comes along. And again, I think that finding the right deal for you is a critical part of the puzzle. Now, everyone's different, and this kind of also, some people don't sort of stop and consider what is the economics of real estate. Some people get a little bit emotionally caught up that, the $1.5 million house is now worth $2 million, which is great. But could you have ever afforded the $1.5 million house that became $2 million? Well, actually, if we were to look into your economics, you're more a $600,000 buyer. So we all have to, play within the realm of what we have. And again, this is why, we got to avoid the lemons, but we got to play in the dirt. And the right deal for you will come along. But you need to understand some ideas around what to look for when it comes to real estate. Now, if you go online right now, most stock is on realestate.com or domain.com is under offer. It's under offer online. And what a lot of real estate agents are doing right now is leaving it unsold online. So there's this kind of way for real estate agents to get a new lead. So basically, a lot of agents are prospecting for new buyers by leaving real estate, basically, which is under offer, as basically for sale online. And it's a little bit, sneaky, but obviously for real estate agents, what they're doing is building up a pool of buyers so that they've got more buyers for the next time they list a property. And of course, when they go and speak to a seller, they can say, well, look, we've had 100 inquiries on XYZ property. I've got those names and addresses, telephone numbers. I will contact all those people if you list with me. So when you window shop, if you like, on the real estate market right now, you'll probably sort of get a bit of a sense of what is going on. There is a lot of demand out in the marketplace, and real estate agents, if you like, are clickbaiting everyone. And so again, this is where your emotions and the psychology of you embarking on buying in 2022, you need to be very, very mindful. There is a game going on, and the game is called FOMO. So without question, there is more buyers than there is stock at the moment, but that doesn't mean necessarily go and lose your marbles when it comes to the real estate marketplace. The other thing which is very, very common on realestate.com right now is that the price is not really the price. The unwritten rule, if you like, if something's online for let's say $500,000, is potentially it is actually worth 20% more than that. And, there was a recent article put out on just, the difference in some of the clickbait between what is advertised and what a property sells for. And Melbourne right now is the worst, where you see a property advertised at a price range. Ultimately, it's probably going to sell for 20% more. So it is generally a great way to rope in buyers for a real estate agent to play with the price. And this annoys the market no end. There are actually some laws against bait pricing, if you like. But because the real estate market's so big and the fines are pretty sort of mild, a lot of real estate agents still use this practice of basically putting a sticker price and then watching the demand come in, and of course getting people emotionally glued to a property, making them feel like they're going to miss out, and of course watching that property shoot up in price there and then. Right, so we got some things to think about, right? So a lot of lemons are getting sold this way as well. People come in, they're a bit frustrated, a bit tired, a bit exhausted from going to so many sort of different property auctions or open homes. And, they succumb to the idea of just sort of buying anything. This happened to me. I've fallen for this. One of the first properties I ever bought, I bought by exhaustion. I just got exhausted. I'd been to about 65 open houses. I literally, had spent near on 2 months of my life going and trying to get a deal in the real estate market at that time. And by the end, I just gave up and was like, oh, that'll do. I've got some other things to move on to with my life. And this is one of the challenges with real estate compared to, for example, the share market. It's pretty clean buying shares. You dedicate an hour in your afternoon. If you know which share you want, you make the trade and, open a bottle of beer. Real estate, polar opposite, could mean 2 to 3 months worth of legwork before you even find that right property. And doing some buyer's agency work in the established market, it has been certainly, relentless when it comes to just how many offers my team has been putting out in the real estate marketplace. And my team will work both in established but also in the new section of the marketplace for a lot of good reasons. And certainly I think some of the stock which, the team are putting on offers on, I think, when we see the price that they end up going for and we miss out because we're not prepared to pay that price, it's I think a lot of people, are ultimately paying over what some of the real estate is worth in the market today. Buying some lemons. Remember, we've got to be mindful we're not going to end up with some lemons in the marketplace. So just remember as well, like some people sort of ask me, well, if people, if there's stock coming to market, doesn't that, ultimately mean that prices will slip away? Just remember, it's an owner-occupier-led market at the moment. So for every owner-occupier selling, they are also buying another property. So each seller, so each listing you've got that goes to market, those buyers or sellers, if you like, are actually rebuying. So a lot of the market, if you like, is just upgrading. So they are basically selling a home but buying a home. So the balance of stock is equal again, right? And we are seeing some stock, because of the extra demand, absorbing stock from the rental market. And again, this is becoming a real problem for renters because owners are selling their property but also buying another property. Any extra people coming into the market are actually quite often shopping on stock which is traditionally been used as a rental property. And quite often, many of the rental properties in the market are just that. They're really good for tenants, but they're not great for capital growth. Not all of them, but this is where a lot of the market, if you like, is not buying what I would class as good A grade or even B grade real estate, and is picking up C and D grade real estate off the back of basically investors selling lemons. Hence why 2022 is the year of the lemon. and I'll be selling my lemon this year. Once I sell it, I'll let you know how it all goes. But we are in a fascinating place when it comes to shopping inside the real estate marketplace. Today, you obviously can go to an auction, buy a property. It's pretty extreme for a lot of investors because of funding. Quite often, you might have a pre-approval at a certain price and go to an auction. You are fundamentally not necessarily approved to buy that property, and a lot of people are, dusting a bit of dough when it comes to having to tip in extra to fund the shortfall between what they can borrow and where a property is ending up on the day of auction. The other big thing which is unfolding really is private treaty sales, which is just basically the idea that you make an offer, it gets accepted, and then you go into contract. Private treaty sales are now rather like a 4 or 5 day bidding war. So what is ultimately happening is stock is going to market, there's demand for the stock, and then the agents are sort of saying, well, put your best offer forward. And, a lot of people are getting frustrated with not being able to secure a property. So they're putting their best foot forward. And quite often it is a very, very, very sharp price for the vendor. So this is what's unfolding. This is what you got to play in, right? The Monopoly board is busy at the moment, and we are seeing some high levels of demand. Certainly the demand is less high than it was, say, mid-2021, but it's still really high. You're seeing stock come to online on a Monday, between Monday and a Thursday. A lot of people are excited about the stock. They go to the first open home, and lo and behold, within sort of 4 days of the first open home, a deal is in contract. Now, you got to ask yourself, that buyer ultimately has very little time to do their research just to make sure that the property is perfect for them. Now, this is pretty common in 2022, right? That, people are entering into contract without necessarily contract terms to safeguard them buying. And we've seen on the news reports of, people losing their deposit because they couldn't rock up with the right amount of money on the day of settlement. Even in Queensland's just announced it's going to change its settlement period because a lot of people were losing their deposits because of a term known as time of the essence. In other words, if you don't rock up on the day of settlement with your settlement funds and you're 1 hour late, you're going to lose your money. And so in other states, you get a notice to complete, like 14 days. Hey, you missed settlement. You've got 14 more days, or that's it, you'll lose your deposit. So many people were losing their deposit in Queensland. The government sort of went, you know what, maybe we should change our law just to facilitate some common sense, such as the volume of trades in the marketplace. So when you're buying real estate in 2022, you're probably going to have to consider, data around valuations, what other things are being selling for. Quite often valuers are historians, so they will look back sort of 6 months prior to when you're shopping. And of course, in a fast market, this can mean data that has occurred 6 months ago is $30,000, $40,000 less because people have already gone past what they were paying, 3, 4, 5 months ago. So in a fast moving market, and I would say we're still quite fast. The market is still quite fast. Maybe later in 2022, it will slow up a little bit, perhaps after the election. But for now, this certainly first sort of 2 quarters, things are still pretty fast in the marketplace. And of course, This means investors need to understand the mathematical equation when it comes to buying real estate. Just make sure they've got a little bit of buffer for something in case they need to, just put the hand in their pocket to overcome some small little differentials in the marketplace. So most of the market, if you like, is sort of institutionalized to buy something built and established. And of course, it's around 91% of buyers buy already established secondhand real estate. And this is where you'll quite often, hear people with some sort of cognizant bias to buying new real estate sort of bag it out, right? And I don't necessarily fall into that camp. I think both established and new property serves a purpose. If you're getting really good A or B grade property and avoiding C and D grade property, you're doing your job as a property investor. I'd rather buy an A grade new property than a D grade established property. So not many people buy new construction real estate. And if anything, this makes the buying of it a little bit easier for property investors because they're not necessarily having to go to auction and not necessarily having to buy properties sort of within 4 days of seeing the property, right? So there is a little bit more bandwidth, which is the advantage. Certainly, not all new construction is good. High quality new construction tends to be really, really, really good for an investment. Low quality new construction should be avoided like the plague. And of course, the idea of shopping, for example, pre-construction and settling a year and a half from starting out buying, of course, is also a responsibility that not all buyers can do. In other words, buying off the plan, if you like, is not for everyone. But certainly for those people who are capable of doing it and also understanding where new construction fits into the market, it is a solution for many people shopping in 2022. Just remember, the idea of it is not to just buy anything either. There is A grade, B grade, C grade, and D grade properties all over the real estate marketplace. And again, as I alluded to, I'd rather buy a grade secondhand property than a D grade off the plan new property, right? However, I'd prefer to buy an A grade brand new property than a C or D grade secondhand property, right? So you've just got to understand how it works. And I'll teach you how to play the Monopoly board so you can cut through the noise and understand, what makes a really, really good property to choose as a property investor. So we want to get your house in order, right? And so if you're going to shop in 2022, the first place to start, in my opinion, is your goals. Just making sure you have a reality check around your goals. Like, why are you doing this for? Is this the right thing for you? Will property investment inhibit some of your future dreams, goals, and aspirations, or will it complement where you want to go? Then, if you are shopping in 2022, you need a finance reality check. What is your bandwidth with finance? How many lenders can you work with if push comes to shove? How much can you actually afford? What does your rental return need to be if you are going to be a property investor? And can you get into a better suburb by spending more and, getting that clear air? Or do you need to buy in the dirt? And if you are buying in the dirt, how do we avoid the lemons? All around finance. Real estate investment is just a game of finance. And of course, research. This is where we need to understand getting your house in order. How do you determine what is a good property, a medium level property, or a really bad property? And so we'll have this discussion so you know how to pivot and play. because real estate shopping in 2022 is a pivot and play position. Personally, I prefer to use a broker than a bank just because it is a pivot and play marketplace. In a very stagnant marketplace, banks are really, really suitable to use. But in a pivot and play marketplace where potentially you're going to need 2 or 3 funders to support what you're trying to achieve, because funder A, let's say ABC Bank will lend you 500, but the property has just gone up to 530, and funder B will lend you 530. You need to pivot and play by going to funder B, right? So if you don't have a broker, you're going to be challenged in 2022. It's not a very good banking marketplace. When properties take 6 months to sell, banks are perfectly fine to use, but really for the most part, investors need to consider using a broker if they are playing in 2022. When it comes to research, obviously there are some good websites I highlight, things like SQM Research, Microburbs, realestate.com, Cordell's, which gives you development applications coming through the system. RP Data Core Logic is a great one for understanding, what is selling. You've got things like, the census, which is always interesting to find out some suburb data, Infrastructure Australia to work out what is going on when it comes to new infrastructure coming to town. So there's some good stuff which you can use when it comes to getting a qualitative look at a piece of real estate. So the idea of buying real estate in 2022 is you've got to potentially start at a desktop level and drill down into a detail level. Detail is, making sure you're at the right open home, making sure your property is, got some really good title attributes. It's got no easements, covenants, impositions on the title. These are very detailed things. And of course, what happens to a lot of property investors, they start with detail and soon realize that the market is way too fast for detail. So they have to almost start at the riskiest place, which is what we call qualitative assessment. The de-risked place, or the less risky place, is detail, quantitative, detailed research, external consultants, valuers, building inspectors. This is all quantitative stuff. But to shop in the 2022 property market, you can't necessarily go straight to quantitative because you might be getting a building and pest inspection done and the property could be sold to someone else, right? And you've just wasted $600 paying for a building and pest inspection. So we want some rules of thumb before we even get to this thing called detail research. And this is where I quite often use the idea of the ABCD system. Now, it's just a system which, again, is just a bit of a rule of thumb. It's just about categorizing real estate in a suburb, all right? So I'll try and explain it to you. Generally, when I explain this, I use a bit of a visual diagram so it kind of makes more sense. But really, to determine how good a property is, you can use 3 dynamics, if you like. Land characteristics, location characteristics, and building characteristics, right? They're the 3. Say it again. Land characteristics, location characteristics, and building characteristics. So if you were to get all 3, land characteristics, building characteristics, and location characteristics, and they were the best of a suburb, you would have a AAA rated property. If you were to get 2 of the 3, but they were the best of the best, that would be a AA rated property. If you were to get 1, it would be an A grade rated property. if you were to get none and you looked at your asset, for example, and you would say, well, the land characteristics is a bit of a B for the suburb. The location is, a C for the suburb. And also the build is just terrible. It's a D. Well, all of a sudden, your ranking of this asset is going to be a lot lower. Potentially the capital growth for the asset going to be completely different to someone who finds themselves a AAA property. Now, let me just visualize it in my own head. To explain this, I might just use some properties I own, right? So I'll start with one of my investments. It's a cracking investment. It's made a couple of $1 million already as an investment. When I look at the land is what I would say a B+. The land itself is flat, which is really, really good because in this suburb, there is no flat blocks. Most blocks are very sloping. The disadvantage to the land, though, is the neighbor can look into the back of the land, right? So the way the suburb basically works is it's quite a hilly suburb, and you can fundamentally see the neighbor's house from your backyard by looking up, right? So we've got land, and we're going to say because it's a flat block, it gets an A, but because you can see your neighbors, kind of gets a bit of a B. So we'll probably say that's a B+ piece of land. The location, though, is incredible. It is the best location in the suburb by a country mile and gets itself an A. The street is where everyone wants to live. It is the closest really street to the beach. So it gets an A+. So we've got a B+, an A+, and then the build. The build is great. It's a contemporary home. The architecture is great. Everyone loves the home. When real estate agents check out the home, they're like, great home. So you've got really 2 A's and a B+, if you like. You've almost got a AAA rated property. Now, when we look into the suburb and we look at what is typical to the suburb, most land is sloping, so it's B land. Most homes are a little bit dated, so they would be B builds. Their location, though, A. So most properties, if you like, are double B+ properties. My property, double A+ property. So what happens is inside of the suburb I'm describing, when buyers are looking for homes to buy, they are obviously interested in some of the best properties in the marketplace. And fundamentally, the home that I'm describing is better than the market. Therefore, there is ultimately, at the end of the day, more people interested and there's less product, which I would describe as AA rated when it comes to this particular property. So does that kind of make sense? Again, very hard when it's not visual. I'll explain another property I own, right? It's an apartment this time. And the land that the apartment's on, absolute A grade. It is perfect. The apartment, if you like, is city facing. The land it's a good size, and there is no problem with the view lines. So the land is absolutely A grade. So I've got nothing in front of me at this apartment. I've got nice uninterrupted views, and of course sometimes this is what makes an apartment really A grade. The location is incredible. It is a heritage street. It's a beautiful street. It's close to shops, transport. It's you could live a life on foot in the street. Location 10 out of 10. It's an A grade location. And the build quality is terrific. It's an architecturally designed property, award-winning, global award-winning piece of real estate. So it's a AAA property. In the suburb, most apartments are either B grade or even down to C grade properties. So again, when people want this suburb because they love the location and they see the AAA property, they're just prepared to pay more for it because there's less of it. Remember, my property better than market. Now, not all my properties are AAA or AA rated. I've got one property, for example, I will describe it to you. It is, from a location point of view, A. It is an A plus. Sits right on the Brisbane River. From a build point of view, it's a C. Like, the building is old. It's it's not a modern functional property. It is a much older property. So I'm going to call it a C, right? Compared to the rest of the market, it is a C building. A grade location, C grade building. The land is A grade, but where my apartment is on the land is really B grade, right? So in other words, I'm at the back of the block. I don't get the best views or anything like that, and I get what I pay for. I didn't pay for the A grade piece of land in the complex. I paid for more a B grade piece of land in the complex. So I've got A for location, B for land, and I've got a C for build. So overall, that would score, if you were to cancel out the A and the C, you would say that is not a triple B property, that is not a double B property, that is a B property. And so again, that B property, if you like, is performing okay. It gets moderate levels of growth. Does my AA property get better growth? Yes. Does my AAA property get better growth? Yes. But what I could afford at the time, I looked for an A quality to complement the strategy of getting growth. So it's going to be very difficult for most people to go out and find a AAA property, even a AA property. But if you can find one characteristic which is going to help support the growth proposition of the asset, you're going to do really well out of real estate. Remember, you fundamentally want to end up with at least one A. You want to end up with an A or B property. Now, I will describe some real estate I've owned in the past, which is C grade real estate, which equals a shitstorm, basically. If you want a shit sandwich, you buy C grade real estate. When I just describing it, C grade land, nothing special about the land. C grade location, nothing special about the location, not neat or anything. And C grade build, basically constantly fixing this thing, repairing it, just shit all around, right? A C grade property, shit land, shit location, and shit building on top of the land. So in that suburb, most properties would be what I would refer to as a double B or even B marketplace. So how does my property perform, or did it perform as a triple C property when people were buying B plus properties? It didn't perform. No one wanted it. It got very little growth. The only way it got growth was things like structural change, which are things like coronavirus. Coronavirus kind of provides growth to the market because of the structural change, not because people want to buy the property, just because there's a frenzy going on. When all of that subsides, what is left is the real estate. And this is where you want good land characteristics, good building characteristics, and good location characteristics. If you can get all of them, that's great. Sometimes it's like the location's not great, but I've got a great building and I've got great land. That works as well, right? So you've just got to think through really analyzing the real estate market so you avoid blunder deals at all costs. Remember, this is the market of lemons coming to marketplace. And of course, you've got to narrow your focus and analyze the suburbs you're looking in and rank your property accordingly and make sure you're buying something which sits in the better part of the market where there would be more demand than anything else. Now, just a little rule with that, you've got to make sure you're comparing apples for apples. So if you were buying a townhouse, you would compare townhouses to townhouses. If you were buying a house, you would compare houses to houses. If you're buying a terrace house, you would compare terraces to terraces, right? You don't going, well, I've got land, I'm comparing land of housing to land of an apartment. That makes no sense. So you've just got to make sure if you're going to use that methodology, which is just a real almost qualitative approach to going, well, this one's a C grade. Do I really even bother going to the open house when most of the market is buying B+ properties, right? So it's just a cool way of analyzing the real estate market so you can narrow your focus and move through this thing called buying property in 2022. Remember, choose some things to focus on. I like to choose land characteristics, location characteristics, and build characteristics. So can really sort of narrow your focus down, and you can start to get a little bit nicher when it comes to understanding how to buy real estate. And again, getting a discount on a D grade property is very common. It's very common, very, very common. I see it so much clickbait on this stuff when because I've subscribed to a few different property people and so forth, and I'm like, there's some buyers agents out there just flogging the shit out of D grade assets. And when you look at the land characteristics, you're like, holy shit, this property is like on a main road. You look at the location characteristics, it's like one of the worst suburbs in the whole of Australia, let alone worst suburb. It's not even close to the shops. Terrible location, D grade land, D grade location. And then you look at the build and it's just, it is just cookie cutter, homogenous shite. And you're like, well, D grade built. And then you're going, well, the clickbait will be, property investor secures $50,000 discount. You're like, man, this person just got loaded a D grade shit box. It's never going to work. Like, yeah, they got a discount, but now will they actually get growth? And this is the stuff you need to be very, very careful of, because at the end of the day, as we've seen and as proven by coronavirus, today people are going to work from home longer. So that means, they're looking for something that has A grade build standard. I remember the characteristics: good building, good land, good location. Today, people are working from home a bit more than ever before, spending more time at home. So all of a sudden, the characteristics of the build are very, very important to people. We're seeing people wanting to change suburbs so they've got more lifestyle. So all of a sudden, the characteristics of location, very, very, very important to people. And again, this is where, I've got the lashes on the back from playing in the dirt. It's okay to shop at an affordable level. And when we talk about A, B, and C logic with real estate, it can be logic in any suburb. It's not about price, right? It's about value. It's not about price. It's about value. So you could go to a suburb where, it's the cheapest suburb in the city. That's cool. It doesn't mean you shouldn't invest there. If you are going to invest there, though, you want the best land, the best location, and the best dwelling on the property to mitigate the risk of going to, the poorer location, if you like, right? So this is the logic you use when it comes to shopping in the real estate marketplace. Don't be a ditherer. The reality is 2022 is a great year to get out and buy. Really, when it comes to you, quite often buying real estate is about you, not about the market. It is like all of a sudden you're finally ready to buy in 2022 and you miss the growth of 2021. Well, how do you compensate that? You make sure you buy a really, really good property and, of course, let time do its thing. Real estate, you've got to search for real estate, research real estate. You've got to work out how to value real estate, analyze real estate, and real estate is time bound because if you take too long, someone else is going to come along and buy that property off you. Don't fall for perfectionism. Understand that a B grade property, based on how I'm describing it, AAA, AA, A, triple B, double B, and B. B grade is your minimum standard. Don't buy C grade, triple C, double C, C, or triple D, double D, or D. Most property investors at an affordable rate can find themselves at a minimum a B grade property. I've got some B grade properties. They've performed really, really well. Of course, if you can hit the AAA and you've got some budget to do it, that's what you should be doing because that's where the best growth is. So don't be afraid. What are you actually afraid of? The marketplace is the marketplace. All the clickbait and all the news and all the noise, turn it down. Most people probably giving you advice not to play in the real estate market are probably broke. So, maybe piss them off because what do they actually know? And what are the worst consequences? The market goes down 5-10% and then you hold on for 10, 15 years and see the property market again structurally change and double. Big deal, right? And what really will happen if you ignore the situation. Now I'll go back to where I started this conversation. I need to look at how much I spend on health every single week. I've got private healthcare. I've got, I'm obviously trying to be as active as possible to live the best possible life. I'm trying to, eat the best possible food. All of that costs money. And I think, even just coming back to ignoring the situation of being a property investor is not an option. Coronavirus proved that. Everyone hiding under a rock is now broke and can't keep up and stuck in the rat wheel. Everyone who took action and bought real estate is pretty happy that they did. Assets lead to wealth in a capitalist society. So don't put it off. Don't wait. There's nothing to be gained sitting around and waiting. The reality is if you just think about how to buy well, you're going to never sell and you're going to hold those really good assets. Hey, I hope those tips were helpful. I'll catch you next time on the next episode of The Urban Property Investor. Thanks for tuning in to The Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of The Urban Property Investor, take care and bye for now.